I, Professor B.K.Jain from Biyani Institute of Science and Management of Biyani Group of Colleges welcomes you in this special lecture. My topic for today's discussion is the RBI as a monetary authority. I would discuss this whole chapter in three parts. One is meaning, and another is objectives, and third one is tools. So far as the meaning is concerned, I would like to make it very clear that the basic policy of the monetary authority, as Reserve Bank of India does, is making available adequate money for growth and development. Reserve Bank also decides cost of money and credit, and based on this it announces its monetary policy. For announcing monetary policy, Reserve Bank of India undertakes review of the economy quarterly, and in each quarter, mid-quarterly review. And this way, Reserve Bank of India undertakes 8 reviews during the year, and based on the findings of its review, it decides or announces monetary policy for the future. Now, the key objectives of this monetary policy, as you may see on the board, they are two: price stability. Price stability means, you might have heard the word inflation. Main purpose of RBI's monetary policy is to control inflation and also ensure stability in the entire financial structure in the country, entire financial system in the country. Reserve Bank of India, there are many tools with it through which Reserve Bank of India announces and controls monetary authority. These are, number one is CRR. It is known as cash reserve ratio. This is the ratio of cash which is required to be maintained by all commercial banks with Reserve Bank of India. This CRR is required to be maintained as per section 42 of Reserve Bank of India Act, and this amount is remain with Reserve Bank of India, on which Reserve Bank of India does not provide any interest. Presently this CRR is 4%. In the last review, which was undertaken in the month of January, this was reduced from 4.25 to 4%. This 4% is of total deposit liability which is required to be maintained with Reserve Bank of India. It is a statutory provision, and violation of this 4% attracts penalty from Reserve Bank of India. The next is SLR, which is known as statutory liquid ratio. Each bank is required to maintain 23% of its total time and demand liabilities in the form of government and government approved securities. This is also a statutory provision as per section 24 of Banking Regulation Act. The next is repo and reverse repo rates. These are the basic rates which are often revised by Reserve Bank of India in its almost every review. In the last review, which was undertaken by Reserve Bank of India on 19th March, both these rates were reduced by 0.25. Now, present repo rate is 7.5% and present reverse repo rate is 6.5%. Repo rate is the rate at which commercial banks borrow short-term money from Reserve Bank of India. By increasing or decreasing this repo rate, Reserve Bank controls the credit. Reverse repo rate is the rate at which Reserve Bank of India accepts surplus money of commercial banks, and whenever a bank is having surplus money and is not in a position to use it in the form of loans and advances, that money can be deposited with Reserve Bank of India, and on this 6.5% interest is being allowed by Reserve Bank. Next is bank rate. Is the rate, which is also known as discounting rate. It is the rate at which Reserve Bank of India provides money against discounting of government securities. And the last one is open market operations. Means Reserve Bank of India comes in the market and starts purchasing or selling some of its items. For example, last few months there was a high prices of dollar. Reserve Bank intervened and came into the market and started selling its dollar reserve, and as a result the dollar price came to the normal. In the end, thank you. For further details, kindly log on to our website www.guruKPO.com.